With key stats due for release next week, we discuss this and more with Bob Mason of FX Empire. This is the week ahead. Hello Bob, and thank you once again for joining us. Let's dive straight in, shall we? A busy week ahead for the major currencies on the economic calendar, with key inflation, manufacturing and GDP figures due for release next week. Can our traders expect significant movement?
It's quite a week ahead on the economic calendar, but that doesn't mean there's not going to be any volatility. We're seeing quite major swings in the currencies and even in the G7 pairings. So looking at the US dollar, inflation figures on Wednesday and Thursday will definitely garner some interest. The markets are pricing in a second rate cut for the quarter by the Fed later this month, and that's to support obviously the economy and offset the effects of the coronavirus. At the end of the week, consumer sentiment numbers for March, prelim figures, will definitely garner some interest. Are we in a situation where the US consumer is going to start tightening the purse strings? We're seeing the spread of the virus across the US, and that's never a good thing. We're not going to see the US government impose similar measures as those seen in China, shutting down and borders of states and putting people into quarantine in the millions. So that suggests that the spread will continue across the US, and that's going to cause major impact on consumer spending, which is key for the US economy. So will the Fed's rate cuts really have a material impact on offsetting the effect of coronavirus? The jury's out, and really probably not, because that's not going to cause people to go out and spend when the threat of the virus remains, and it's not going to affect or improve supply chain conditions and trade terms. So all in all, it's a bit of a tough time at the moment, so that means volatility is going to remain. Looking across at the euro, economic data, we've got German stats on Monday that will garner some interest, but industrial production and trade figures, those are January numbers, and we're not going to expect, while they may be weak, just the fact that the German economy is struggling, they're not going to reflect the effects of the coronavirus. So again, expect the markets to be relatively forgiving to any of those numbers, but the upside to the euro will be limited from the stats, that is. On the monetary policy front, however, is the ECB going to stand pat on Thursday? We've heard two sides of the coin. We've heard ECB President Lagarde from the previous week talk about holding stat until they see deflationary pressures build. We've seen evidence of that, but not enough to force the ECB into action. And then we heard from Deputy Chair or Vice President of the ECB talk about the ECB's willingness. It is really the first time the ECB has the chance to force EU member states to loosen the purse strings, however. And obviously they're going to be targeting the likes of Germany to deliver fiscal support. So, we could see further upside for the euro should we see the ECB stand pat. And that, obviously that means that, economically the data may become a bit of a challenge coming into March once the effects of the coronavirus, become evident. But then if we do get fiscal support, then that's even more upside for the euro, really. So we could start seeing the euro start approaching 1.14 levels against the dollar. Stats-wise here, German stats at the beginning of the week, inflation, finalised inflation numbers aren't going to do anything. For the UK, we've got a busy Wednesday. We've got manufacturing, industrial production, GDP numbers out. That could really turn the screw on the head on sentiment towards the BOE and whether the BOE is going to deliver a rate cut later this month. Currently, it looks as though the BOE is going to stand pat. That's provided support to the pound. Obviously, that could change, drop of a hat. BOE Governor Carney had suggested that the BOE is willing and able should the need arise, but they aren't going to move until the alarm bells start ringing. So, these stats are going to be particularly relevant. Obviously, then we've got Brexit chatter in focus, though, we're going to get some resilience in the pound there. The market's been through this walk before with the EU, so it shouldn't be too dire. But volatility is definitely going to remain through the week. More upside for the euro. That's hardly going to do too much good for the likes of Germany and, the manufacturing sector.
With recent RBA cuts leading to low consumer confidence, can we see an upturn for the Aussie dollar and also the Kiwi? How's that looking?
For the Aussie dollar, well, it's quite a week. The RBA cut rates, yet the dollar was on the move. The Aussie managed to move more than 1% over the week. We've been seeing a lot of these swings particularly through this part of the year. First we had trade war with China, and now we've got the coronavirus. So the promise of fiscal and monetary policy support is expected to drive demand for commodities and provide some offset to the impact of the coronavirus. We did see risk aversion return on Friday, however, and there is some doubt over whether the governments will deliver, bazookas in terms of fiscal policy or just, trickle it in, because there's still some uncertainty over how much damage the coronavirus is going to have on the global economy. Monetary policy, the Fed's delivered, the BOC's delivered, and the RBA's delivered. ECB, BOE, we're not quite sure yet. The Bank of Japan's been holding back for almost a year. So will they deliver? We need to see the spread of coronavirus abate, however, and for borders to remain open and for travel restrictions to stop rising, really for the markets to be able to assess the damage. We can't quantify this right now. So that does leave the Aussie dollar and even the Kiwi dollar, under the swinging pendulum at the moment, and we can expect that to continue. On the economic data front next week, we've got consumer and business confidence numbers out of Australia. As we all know, RBA rate cuts tend to have an impact on consumer confidence. On the negative front, retail sales figures last week were negative. So a pullback in consumer spending, that's not particularly good for the RBA. Are they going to cut even more? They've promised more cuts. Whether they do or not remains to be seen. I think they'll want to see what the fallout is, even if consumers do stop spending or at least cut back. For the Kiwi dollar, next week's business PMI numbers on Friday will definitely garner some attention. We saw trade data out of New Zealand. Those were January numbers that are yet to reflect the effects of the coronavirus. February PMI numbers will definitely give the markets an idea of what's to come, which could lead to a pullback in the Kiwi dollar. We're not talking about RBNZ rate cuts right now, but when considering the effects of trade, they might need to step in, and retail electric card sales will also give some indication of how consumers feel about the spread of the virus. So plenty of volatility yet to come.
An improvement for the Japanese yen and the Chinese yuan recently. What has driven this improvement, and do we expect this to continue into next week?
For the Japanese yen, it's been quite a turnaround. We saw the yen at 111 levels against the dollar just a couple of weeks ago. Now at 106. We're not looking at economic data. Economic data means nothing for the Japanese yen. It's recaptured its safe haven status. That's largely come from the spread of the coronavirus across the US. And assuming the US government doesn't shut down states, borders, towns, close schools, and quarantine, obviously affected areas, that direction in the yen is likely to continue. Even with the BOJ, promising monetary policy support. We've seen that happen before. We've seen the BOJ ease monetary policy and the yen to gain. And, this risk aversion is coming and going, but it's unlikely to disappear. This spread of the virus isn't abating just yet. So obviously there's going to be plenty of support for the yen. Are we going to see the Japanese yen at 100 levels against the dollar? Well, the Japanese government definitely hope not. But, it's plausible should the spread of the virus in the US become quite material and a pandemic abate. Don't forget, we're not at the stage yet where we're seeing border shutdowns across Europe and for state lines to be closed in the US. That's sort of draconian measures that remain on the cards should the spread continue and the death toll rise. So all in all, support for the yen. We're unlikely to see the yen slide back. I mean, this virus isn't going to disappear tomorrow, and trade terms aren't going to improve overnight. So expect support for the yen. For the yuan, they got support this week. All credit to the Chinese government. They managed to contain the virus. The reality is, however, the damage to the economy is significant, and it remains to be seen whether G7 fiscal and monetary policy support will turn that around and drive enough demand from China to support the economy. So jury's out. We need to quantify the damage right now to see what impact that's going to have. So the yuan's back at sub 7 against the dollar. That could reverse, however, particularly if we suddenly see a spike in cases in China again as factories reopen. In a bid to start, reigniting the economy.
And finally, with trade talks on hold and all the talk now about the coronavirus, is there any other geopolitical risks that we should be looking out for?
On the geopolitical risk front, we've got Brexit. Last week we saw the UK government going head to head once more against the EU. This time it was fisheries. British government's not going to give up British waters and fish for the EU anytime soon. And obviously that's caused some friction. Amazingly, the pound remain resilient to the negative news. Barnier had a bit of a hissy fit, but still talked about the prospects of an agreement at some point. He is assuming that Johnson's going to give up British waters. I'd hazard a guess that he's not. He'll give it up, or some of it, on the promise of getting everything else he wants. And I'm sure the British public would be more than happy to exceed some of the fisheries, in favour of, removing all strings from the EU. So Brexit, expect chatter to continue, though we don't expect too much disaster for the pound near term. There the focus remains on policy. On the US election front, Biden took the lead after Super Tuesday. That's market positive. We don't want Sanders in there. Well, the Bulls don't anyway. So if Bernie Sanders gets any traction next week, then expect risk aversion to play. The markets don't want Sanders against Trump in the election race. So Joe Biden needs to stay up front. Elsewhere, we're not expecting too much. Obviously, focus remains on a concerted and coordinated attack on the coronavirus to support the global economy.
Well, thank you so much for joining us, Bob. That's all for today, and we will see you again next week. This was The Week Ahead.